everyone seems to keep asking, when is the Fed going to cut its rates? Wrong question. The smarter one is, what happens after they cut? Because a rate cut, well, it's not magical. It's just simply the first domino. What really matters is how the others fall. And history does show us that the first 90 days after that cut, they often set the tone for the entire year. That's where the real shift happens. Small caps versus mega caps, bonds versus cash, defensives versus cyclicals. Whoever seizes momentum early tends to hold it. So today, we're going to map out that mechanism. We're going to look at past cycles and how money is positioned right now, and why small caps might be the forgotten value aisle in the store that suddenly everyone rediscovers. But before we unpack all this, if you get any value from my content, please consider pressing the like button so my channel can continue to grow. Now, rate cuts don't just make debt cheaper. They flip the entire market narrative. Think of it this way. In Act 1, inflation was the villain. Now in Act 2, growth fears take the stage. When Powell shifts from inflation fighter to growth protector, it's a scene change, and every investor has to rewrite their script. Right now in late August, soon to be September when this airs, the setup is really unusual. Investors are sitting on a record $7.2 trillion in US money market funds.
Oh my God.
That is a mountain of idle cash, and it's just parked in the safest asset that there is. Meanwhile, the futures market is assigning about an 85 to 90% probability to a 25 basis point cut in September. Granted, there's no fireworks going off, but it is enough to at least mark a turning point. And we have optimists that argue that a pile of cash will soon leak into the risk assets, like water just finding the cracks in a dam. And then, of course, we have skeptics, like Goldman in particular, that note that households typically hold about 15% of their financial assets in cash. That's right in line with today. In other words, don't expect a tidal wave all at once. In either way, the cut is truly setting the stage for what comes next. And before we look back at history, it is worth widening the lens a little bit. The UK's central bank just cut to a 4% rate, signaling that they're near the end. And the ECB has stayed cautious at 2%. Japan is doing the opposite, though. They're nudging rates a little bit higher after ending its negative rate experiment. And China, of course, is leaning on targeted stimulus, while freight costs, which spiked on tariff news, are finally starting to ease a little bit. Now, those global moves, they matter because they ripple back into the US long-term yields and, of course, the price of goods. In short, the Fed may be cutting, but cross currents from abroad, well, they're going to keep the backdrop a little bit messy. So what exactly can history teach us? Because not all cuts are going to be equal. Back in 2001, the Fed started cutting in January as the dot-com bubble burst. Equities or stocks, they still fell, and desperation cuts couldn't really ease the fear. In 2008, cuts were simply about survival. Credit markets froze, banks collapsed, and equities or stocks completely cratered. Treasuries were about the only safe place. The old saying held, return of capital mattered way more than the return on capital. Fast forward to 2019. Growth was slowing, but the economy wasn't in a crisis. The Fed made a preemptive cut, and markets treated it like a little bit of a safety net. Risk assets rallied. Small caps, well, they jumped at first, even though over time, mega caps really ran way ahead on the scoreboard. And if you look even further back to, let's say, 1995, it offers a little bit of a quieter precedent. Mid-cycle cuts that extended the expansion, and they really rewarded a risk without really a crisis backdrop. So the overall takeaway, 2001 was all about desperation. 2008 was about survival, and 2019 was simply proactive confidence. I get that it's not a perfect match, but today seems a lot more like 2019 than the others. And of course, this brings us to small caps. They're not simply just rate sensitive, they're cheap. So let's put some numbers on it. The S&P 500 is up about 10% year to date. The Russell 2000? Well, it's only up about 5 or 6%. And valuations tell the same story. The S&P 600 trades around 15 to 16 times forward earnings. The S&P 500 sits around 22 times. And when we take a look on sales and the book value, the spread is just as wide. Large caps are sitting around 3x sales and 5x book. And then, of course, small caps are closer to 1x sales and only 2x book. That happens to be one of the widest gaps in years. And one such small cap stock that you might want to research is today's sponsor, BioStem Technologies, which is a med tech innovator innovator focused on regenerative therapies, using proprietary perinatal tissue allografts to heal chronic non-healing wounds, like those from diabetes and surgery. These treatments are vital given the global wound care market is projected to reach $27 billion by 2027. BioStem reported record revenues in 2024 and $72.5 million net revenue in Q1 of this year. That's a 73% year-over-year increase. And preliminary Q2 reports showed $49.3 million in net revenue, and its sixth consecutive profitable quarter. With a $30.8 million cash balance, Zacks Small Cap Research maintains a $25.50 price target. The company's proprietary BioRetain processing method creates best-in-class placental allografts, which are clinically proven to deliver superior wound closure for diabetic foot ulcers. This technology, along with a robust patent portfolio and active NASDAQ uplifting efforts, positions BioStem for significant growth. But if you want to learn more, check out the link down in the description. Now, let's connect the dots on why small caps respond so quickly. And it's because the debt structure is the entire key. So roughly 40% of the Russell 2000 debt is a floating rate. And for the S&P 500, it's only about 9% of the companies. So when the Fed cuts its rate by 25 basis points, it's like lowering the entire rent bill for small caps almost overnight. And that relief flows straight into its earnings. And history supports this, because after the final cut in past cycles, small caps outperformed dramatically, up about 36% after just 1 year, and 42% after 2. Now, when I worked at Target, we often tested promotions in smaller categories. But here's the thing, money doesn't just cannonball into equities on the first day of the cut. It moves in sort of a step-by-step process. First, it's going to flow out into T-bills. Investors want safety, but they're willing to inch out the curve once cash yields begin to slip. From bills, then it moves into bonds. So if inflation cools, then duration gets bid up. But if inflation stays sticky, then services holding near 3% or tariffs are keeping goods priced high, then the bonds completely stall out. And then you get just a one and pause moment. From bonds, confidence can finally rotate into equities. And historically, small caps benefit most in the early stages of easing. And then comes sector rotation. So let's say that we have a soft landing scenario. Cyclicals like industrials, financials, and discretionary names take the early lead. But in a sticky inflation scenario, defensives like healthcare and staples quietly begin to absorb that cash. And of course, here's a tell worth noting. Buffett's Berkshire just disclosed its $1.6 billion stake in United Health. That's not speculation. It's a defensive hedge against sticky services inflation. Think of that flow ladder like water just running downhill. It doesn't ever skip the steps. It's just going to trickle. First cash, then bills, then bonds, and only then does it spill into equities or stocks, right on down that hill. Now, small caps are exciting. But here's the catch. They're also extremely fragile. Bankruptcies hit 71 in July, the highest month total since 2020. And year to date, we're at 446 large filings, the most since 2010.
I declare bankruptcy!
And that's your reminder that these companies are more sensitive to credit tightening. Think of it like running your household budget. If you've got one unexpected expense and you don't have a lot in savings, then you're going to feel it immediately. But on the other hand, large caps, they have a lot of cushion. Small caps don't. Here's how I would frame it from a long-term, semi-conservative perspective. Anchor on quality. If you're looking at small caps, then think of the S&P 600, not speculative lottery tickets. Of course, if you look at my portfolio in my free newsletter, then you already know that I have a handful of small cap stocks where I only pick what I believe are going to be the top of the top, and they're going to win long term. Next, a person could stage into bonds gradually, and I wouldn't rush it, then run a barbell. Small caps on one side, defensives simply on the other. And a good reason to plan for either one of those outcomes is because with the latest news that most of the tariffs may be illegal, then if that ruling holds and tariffs collapse, we'd potentially have a major boom in the stock market because the rates are still planned to be coming down. And if the inflation-causing tariffs are also removed, that would potentially make every scenario a winning scenario. Now, before we get ahead of ourselves, we need to keep an eye on credit. Rising bankruptcies are the early warning system that the story could easily flip. So here's the bottom line. A Fed cut is just the first domino. What matters is which playbook shows up right afterwards. If this happens to turn into another 2019, then quality small caps could finally get their moment. But if that ridiculous inflation stays sticky and hangs out for a while, then defensives and the mega caps are going to quietly lead the charge. Because when Powell finally blinks, all of these dominoes are going to fall. And I don't know about you, but I don't want my portfolio standing still while everyone else is already making their move. As always, thanks so much for watching.